Hi everyone, I'm Lee. Welcome back to my channel. Project 120 is a challenge I put to myself to make 120,000 in a year on top of salary by various means. Trading investing is one of them. I'll be showcasing two of my trading accounts for about 12 months and we'll go from there. Let's get to it straight away. This is the screenshot I shared in the last update about my Tiger trading account. The market value went up last week by about 5,000 to 12,700 due to a bull run of the Chinese internet stocks. Fast forward to this week, the market value stands at 14,700. In the past week, I made some profit-taking moves, including closing my position on Baidu and reducing my position on Tencent. As I shared previously, there are two considerations that kind of dictate my decision when it comes to option trading. One, option contracts are time sensitive. I want to act before expiration. Two, these are primarily short-term investments. I want to take profit when I see fit. These two factors are both linked to another key concept about options. When I say options are time sensitive, not only because the option contracts become invalid after the expiration, but also because the price of contracts is directly linked to time. So today we're going to look at the pricing of options. An options price is primarily made up of two distinct parts: its intrinsic value and time value. Intrinsic value is a measure of an option's profitability based on the strike price versus the stock's price in the market.
What?
Yeah, I know. They always have a way of making simple things complicated. Put it this way. If a call option contract's strike price is $90 and the underlying stock price is $100 at a time, the intrinsic value of the call option is $10. It makes perfect sense, doesn't it? Because now, as the buyer or owner of the call option, you have the right to buy the stock at $90 and sell it instantly at $100 using the option. So the call option is worth at least $10. That is the intrinsic value of the option. I'll give you another example. The strike price of a call option is $105 and the underlying stock price is $100 at the time you buy the call option. The intrinsic value of the call option is zero, right? Does it mean that the call option is worthless? Not really. Depending on how much time is left before the option expires and how volatile the underlying stock price is, the price may go up to beyond the strike price of $105, or it may go down lower. Nobody knows. But that uncertainty is what people are betting on. There are mathematical models behind the calculations of time value, but I've learned that what is fascinating to some may be extremely boring to others. We'll explain the topic on volatility, or more accurately, implied volatility, when we talk about how to select the best strike price. I feel it's probably more relevant then. For now, we just need to understand two things. Number one, the price of an option equals to its intrinsic value plus its time value. Two, the time value of an option in general decreases as you approach the expiration date, barring some extreme price movement. Now, let's talk about why I selected these stocks for option trading. Human nature is such that if you don't want to do something, you can easily find 5 reasons not to do it. Conversely, if you want to do something, all you need is one good reason, and you forget about all the other 5 reasons. Fortunately, I have 2 good reasons. Firstly, they are cheap. In the world of investment, cheap and expensive are relative to a company's worth or valuation, not the number on the price tag. To give you an example, the famous meme stock GameStop, its share price is $16.47 US, but it is by no means cheap. If you look at the trailing 12 months PE, which means price to earning ratio, it's 823.5. What it means is that the price of one share is 800 times of the earning per share. In other words, if you own the company, Judging by the rate this company makes money in the past 12 months, it would take you 823 years for you to make the same amount of money you put into this company. That's how much you are paying to buy the shares of this company. Of course, this is just to give you an example of the parameter used in judging whether a stock is cheap or expensive. There are a few more parameters like that. Price to book ratio, price to sales ratio, free cash flow, just to name a few. By almost all measures, these three Chinese tech companies are cheap. However, there are reasons why they are so cheap. I mean, if they are good companies, why wouldn't investors buy their shares? The story started from year 2020. That's the year when the pandemic started. Later that year, Chinese authorities initiated a regulatory storm against Chinese tech conglomerates out of concerns that these internet platforms were becoming too large and too powerful. Long story short, the crackdown wiped out trillions of dollars in market value from Chinese tech companies. Investors, both foreign and domestic, were really spooked. They did not see this coming, and they are worried it might happen again. Apart from that, Chinese economy has not recovered from COVID as fast as everyone hoped to see. The earnings of these big techs also took a hit in the past 3 years. Their share price dropped by 70% to 80% from their highs. The problem with stock market is that when fear gets spread out, price gets overkilled. The opposite is true too. That's what I remind myself constantly. Now, the second reason is really just a logical development from the first. As the Chinese economy slows down, problems start to emerge. Real estate bubbles look like they are popping anytime. The Chinese stock market plunged to a 5-year low early this year. People were panicking. You think the Chinese government is going to do nothing? Of course not. After the Chinese New Year, all kinds of policies benefiting the capital market were announced one after another. I knew it's time to buy. Will these policies eventually work? Will the recovery be sustainable? Nobody knows. But just as bad news overkills share price, good news pushes share price to unreasonable level too. As Warren Buffett famously wrote in a 1987 letter to Berkshire Hathaway stakeholders, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. These companies are cash-making machines with rather strong fundamentals. Their share prices will not be suppressed forever. So those are my reasons to invest. The share prices are low and bound to have a rebound in the short to medium term due to both policy shift and valuation restoration. Now, moving on to the other trading account. This is the screenshot I shared in the last update about my Moomoo trading account. The market value continued to drop by about $1,000, mostly due to the cutting loss trades on Coinbase. I recently bought some Tesla put options, but today we probably don't have the time to talk about those. Let's give them some time and we'll come back to review them maybe next week. Again, thanks for watching. Until next time.